You know what's crazy? I spent over $15,000 losing money trying to figure out the structure of the market. And it wasn't because of bad strategies or bad indicators. It was because no one taught me the importance of structure of the market. Everyone tells you buy support and sell resistance or follow a trend. But what defines a trend? What is a valid support and resistance zone? How do you understand the context of the market? No one tells you that. I mean, I can give you most generic advices as well. But will that help you? Absolutely not. So if someone would have told me about the importance of market structure on the day one of my trading, it would have saved me from a lot of frustration and it would have saved me a lot of money as well. So in this video, I'm going to cover everything that is important for you to understand about the market structure. And by the time you guys finish this video, you'll have a complete context of the market. So let's get started. So the first part of this video is about the misconception that every trader has. Now, I'm sure your favorite guru or your mentor or any individual that you have been following while you were trying to learn trading, everyone tells you to keep your chart as clean as possible. Do not overcomplicate your trading. And I completely agree with them. What will happen here is, let's say you have a resistance zone just around this area. And then you've got a support zone just around this area for the sake of example. Now, you'll try to sell when the price reaches your resistance and you'll try to buy when the price reaches your support. That is basically how trading works. But something that you are missing here is the context of the market. The market is ranging. It's just a sideways move and nothing else. So what might happen is that price will reach your resistance zone. You might get a confirmation to sell it. It might give you slight move in your favor, probably stop you out and then get back inside the zone. So you'll just get caught in the chop and you lose the money. That is how it will go. So for you, if you understood the context of the market, if you understand the structure here, you would have saved a lot of money for yourself as well. So that's the importance of understanding the market structure. So it's the misconception that every trader has, that I need to keep my chart absolutely as minimum as possible. Yes, you do. But after doing an in-depth analysis, then keep your chart clean. Do not just mark a support and expect that price will every time reverse from it, or a resistance zone and you can sell every time when it hits that. That's something that you need to get rid of right now. So in reality, the market is actually a storyteller. And every single move, every push, every pullback is just a part of that story. So you might have started using RSIs and moving average and all of those indicators. And I'm fine if you use that. That's not an issue. But if you are using an indicator just to get a buy or sell signal, I would say stop right now, because that will only make you lose money. So it's very important that you do not just blindly trust the indicators. If your indicators give you some kind of data using which you can come up with a decision that, okay, this is bullish, this is bearish, or I can buy here or I can sell here, then it's fine. But if your indicator is just made for one purpose, and that is to give you a buy or sell signal, I don't think so that makes any sense. So as I said, market structure comes first and then you align it with your indicators. So it does not matter if you use 1 or 10 indicators, first market structure and then indicators. So now coming to the second part of this video, and that is about what actually is a market structure. I mean, you've heard a lot of traders or individuals talk about it, but what is actually a market structure? So just for the sake of example, you guys can see that I have opened a gold chart. On 15 minutes, this absolutely looks bullish. It is moving towards the upside. That is what bullish means. If I just switch to the daily time frame, what you guys get to see is just a one-way push towards the upside. There is no pullback. There is no retracement or whatever terms that you guys like to use. So this is one of the most unhealthiest price action that you can ever see. The market structure here is absolutely bad. But why? Because why would you call something this strong bad? The reason is there is no retracement at all. If the market would have done something like this, I would have called it the best kind of market structure. But this right here is just a one-way push towards the upside. Market can collapse even with a single trigger of geopolitical news or anything else. The sentiments might shift, the narratives might shift, and this can be the biggest jump in the history of gold as well. Just how we got to see in Bitcoin on the 10th of October. Yeah, so this was one of the examples of an uptrend. I've started by showing you what is not the best kind of a trend. Let me give an example of what is a good trend, since we've talked about the bad one. So this is a S&P 500 chart. Now the asset does not matter because we are only focusing on the market structure. What you get to see here, that the market made a low, it went higher. It made a clear low, right? Then it went higher. A clear top, a clear low. A clear top, probably if we get to see some kind of retracement, we'll have another clear low. This is something which was missing on the gold chart. So it's very important that you get to see some clear highs and clear lows to define what the trend looks like and is it strong or is it not strong. So that's something which you guys need to consider as well. So market structure is basically the skeleton of price action, and it's how the market breathes. Think of it like this: if price is the skin, then market structure is the bones underneath that, giving it shape and direction. So market structure is basically made of highs and lows if it is a trend, or just a sideways price action when it is in a ranging market. That is how you understand price action, and that is all that you need to know about it. That's all. But you also need to use it with the context when you want to get into a buy or sell trade. We are going to get to that point as well. So here are some of the hidden truths about the market structure which people do not usually talk about. So market structure is extremely fractal. So you might get to see a 15-minute uptrend, but on the same asset, when you get to a daily time frame, or let's say on a 4-hour time frame, you might see a bearish trend. Trends might be different on different time frame. So you will get caught in this whole chop, in this whole uncertainty of the trends. So how do you tackle that? The only solution to this is a top-down analysis. You start from the weekly time frame, then you get to the daily time frame, and then you'll shift to, let's say, 8 hours, and then 4 hours, and then 1 hour. This is how you can create a bias. You can see what maximum time frames tell you. Let's say the price action on the maximum time frame, let's say on 1 hour and then 8 hour, and even on the weekly, it is absolutely bullish. You can consider your bias to be bullish as well. And when the smaller time frames, they start to align with your bigger time frames, you can plan a trade then, and that has a higher probability of playing out right in your favor. So once you understand all of this, you are no longer just reacting to the market. You are aligning yourself with the market structure and with the bigger players as well. So now let me talk about one of those moments when everything clicked for me. On this Bitcoin chart, when the price was just around the 69,000 marker, I was trading this market. I was looking at the charts and I saw that, okay, this is extremely bullish on a 4-hour time frame. We are making higher highs, we are making higher lows. And as soon as I got to see this break towards the upside, as soon as we took out the previous highs, I expected this to be a break of the previous high and then a continuation, a breakout, and we might get to see our next bigger move, the next continuation. That is what I was expecting right here. But probably just after a couple of hours, I was actually liquidated on this trade, and I'll tell you, I did not place a stop loss. That was my mistake. Stop loss are very important and you guys should always use it. But yeah, I did not use a stop loss. I was using leverage, I was using high quantity, and I got into this trade and I was expecting this to be the breakout move. But what happened was something like this. We just went higher, we reversed. Now talking about this move, why did this actually happen? I'll come to that point as well in the next segment of this video. But let me talk to you about what happened here. I was looking on a 4-hour time frame and I saw a clear uptrend, strong highs, strong lows and everything. But what I missed was the overview of the market, the whole context. And when you zoom out, or if you would have went on a bigger time frame, you would have just saw that the market was doing nothing but made a high, and this was nothing but just the next lower high. So your high, lower high, and this was all just a bearish trend. Even the lows, if you just see, you made your low, your next lower low. That is exactly what we were making. That is exactly what you were doing here. So it's very important to understand the bigger time frame first and then align it with the smaller time frame. So here is a live example for you. And this is the moment when everything clicked for me as well. This is when I started giving a lot of importance to the market structure, and something that you guys need to do as well. So this was actually one of those days when I realized that if you don't understand where you are in that particular structure, you're not trading, but you are gambling. So it does not matter even if you are using 10 different indicators. They might have given you a buy or a breakout signal, but it was market structure which would have definitely saved you from getting caught into that chop. So remember how I was telling you guys that I'll give you an understanding why this breakout failed and why did we get back inside the range and we started moving lower. Now let me explain you something. Understanding that will also give you an understanding about the failure of this move. So now we're trying to understand how to actually read the market structure. We've learned a lot about the structure, the highs and the lows. So the point one is already clear. We know how to identify a trend. So that's sorted. You know what are higher highs, you know what are lower lows and all of those things. Moving to the next part, and which according to me will save a lot of money for you, is identifying the ranges and then accepting the fact that you cannot always trade a range, because that is where you get chopped up. So when you try to understand the whole market structure scenario, you will always want to understand what was your major high, what was your major low, and anything that is happening in between these highs and the lows is nothing else but just an internal market structure. Now I've created a dedicated market structure video as well. You guys can check that out. You can understand a lot more other than what I've been talking in this particular video. So after this video ends, probably you can check that out. The link to that video will be in the description. And while you check it out, guys, make sure to hit the like button as well. It really helps with the growth of the channel. So yeah, when you are marking the levels, when you're marking your support and resistance and everything, you also need to understand what was your major high and major low, and anything in between them is not supposed to be considered as a trend. So let's say this is a clear downtrend. You made your low, market gave you a retracement, you made your lower high, and now you are just ranging inside it. So anything inside it, even if you start to make something like this, lower lows and lower highs, that is not a trend. Do not consider this to be a bearish trend and okay, short it and hold it as a swing trade. That is not how you're supposed to trade it. Yeah, you can probably scalp it, you can take some day trades, but yeah, do not consider that to be a swing trade. Coming to the second point, and that is liquidity. Now, I'm sure you guys have heard about liquidity, you guys have heard about liquidity sweeps and all those fancy terms. But even when you just look at the market structure, you can identify where the maximum liquidity is, and you can plan your trades accordingly as well. So remember that failed breakout trade that I was talking about earlier in this video. To understand that, let's understand this particular point first. When you are in a range and when you have created the highs and created the lows, every time when someone places a short trade, they are placing their SL above the previous highs. That is where their SL goes. And anyone who's getting into a long position throughout this range will be placing their SLs below the current lows. So that is how the traders are placing their SLs, or probably that is where maximum traders will get liquidated as well. If you've identified the range on the basis of market structure, you have also identified the extremely high potential liquidity levels where there are maximum stacked liquidity. So what you might get to see that price will range, and since there is a lot of stacked liquidity around here, you might just dip into that, sweep it out and get back inside the range. And now the chances are very, very high that you might get to see a range rotation, that you might go from bottom of the range till the top of the range, and probably then you might get to see a break of it. So that is exactly what happened when I got liquidated on that particular trade. I had this highs marked. There was a lot of stacked liquidity. Price just went above it, grabbed all of that liquidity, and then we just started to dump. So that is how you can understand where you might get trapped in a breakout or breakdown. So once you know the structure, your entry becomes obvious, and then you are not forcing trades, you are just catching the rhythm of the market, and then you are going with the flow and not against it. So since we've understood about the market structures and the range and the liquidity and traps, another important pointer to that liquidation point was, if you can identify that, you can also identify the highest probability zones for reversals. So let's say if the market is in a clear uptrend, the market is making higher highs and higher lows, and now we made our new high, we made a new low, and the market is just ranging inside it. For the market to reverse from a clearly strong uptrend, you would want it to get a sweep of the highs, get back inside the zone, and then you can expect that the price now has a extremely higher chances that it might switch back to a downtrend. So that is also how you identify potential points of reversals for yourself, and then you can get into a swing trade there and not in the internal market structure. So this was also a point of realization for me, where I understood that trading was not about predicting the points or buying at every support zone and selling at every resistance, but it was more about positioning yourself with the market makers and the market structure, and then getting into the highest probability trades. That was my biggest realization point in my trading journey, and after that it has made me a lot of money and saved me from a lot of frustration as well. So that is exactly when the charts started to go from chaos to clarity, from stress to flow, and from losses to profit. And this market structure thing is absolutely something which I wish someone taught me on my day one of trading, because this would have changed a lot of things, a lot of restless nights for me and a lot of losses as well. It would have saved me from all of those things. So I'll tell you, give importance to this. Do not take it lightly, because this is definitely a game changer. Your 10 different footprint charts or 10 different indicators might save you, might not save you, but understanding of market structure will save you in any kind of market scenario. You will be able to trade any asset at any given time at any particular level. You can do it very easily. So if you're watching this and you have been struggling with entries and the trends and the random losses, stop adding random indicators, start mastering the market structure. And that is the foundation of every winning trader that you have ever admired. Because once you start to read the market structure, you can literally see inside the candles. You can understand the strength and the weakness, and that is what makes money for you. So if this video changed your perspective, drop a comment saying structure changed me. And if you want me to break down how to combine structure with liquidity and volume, hit that like button and we'll cover all of that in the next video.